All right, in this video, we are going to discuss the credit market, or sometimes called the loanable funds market. This is the market where borrowers and savers come together to essentially transfer those funds. Specifically, demanders of credit are going to be households, typically households and firms, and sometimes governments that run a deficit. We talked about crowding out before, but households are going to, take out a loan. So when we demand credit, households are taking out a loan, firms are taking out a loan, governments are borrowing money or taking out a loan to pay for things. So when households demand credit, they're borrowing money, they're taking out a loan in order to finance a large purchase, a house, a car, education, retirement. These are all quote unquote big purchases that have to be financed, or typically financed through a loan. I guess retirement's a bad example, but retirement's a bad example. Typically, retirement and savers for retirement are going to actually lead to suppliers of credit. For firms that demand credit, they're demanding credit. They're going to take out a loan because they want to invest in certain projects that are presumably going to be profitable for them. So on the other side of the market, the supply for credit, demand for credit, again, demand, supply, relationships, all the way from when we studied demand and supply. Remember that demand and supply of anything are just relationships between the quantity and the price. So in this situation, the supply of credit is the amount of credit that's being supplied by banks, but that supply of credit is financed or sourced from households and firms saving their money. Okay, so when we talk about the supply of credit, yes, technically banks are supplying credit, but those funds are generally generated through deposits or savings of households and firms. Okay, so when we piece together demand and supply for credit, it's a market similar to what we've seen before, where we have this downward sloping demand curve. And just to unpackage this a little bit, the reason the demand curve is downward sloping is because as the price of loans increases, well, the quantity of loans demanded is going to decrease. Law of demand. Why? Why are quantity demanded of loans going to decrease as the price of loans goes up, or the price of loans being equal to the real interest rate? Well, for households, if something becomes more expensive, then they're going to do less of that. Okay, interest rates increase. Some households can't afford to take out the loan as much. But firms, on the other hand, their quantity demanded for loans is going to decrease as the price goes up too, because some of the projects that they were going to invest in are now when interest rates are higher, are now not going to be able to finance a project because that project's not going to be profitable given a higher interest rate. Okay, so the law of demand holds in the credit market. Same with the law of supply. As price goes up, quantity supplied is also going to increase. There can be changes to the demand for credit. So when do borrowers change their habits for loans? When do we see increases in demand for loans? Well, from a firm standpoint, when the firms are more optimistic about their projects, if they find more opportunities to be profitable or more investment opportunities, they are more likely to take out a loan. So, if there's a pandemic going on and a firm sees the value in investing in moving online or moving virtually, They may need to take out a loan to do so. Well, in that case, their preferences for loans have changed and their investment opportunities have changed. Therefore, firms may be more likely to take out a loan to finance those investment opportunities from being in a pandemic. Same idea with preferences applies to households. When households are more optimistic about their income expectations or their ability to pay off a loan, they're more likely to take out a loan, to demand credit. Lastly, if there's crowding out, if there's a potential for crowding out, where government needs to borrow to pay off some of its bills. In all of these cases, we're going to see an increase in the demand for credit. When there's an increase in demand for credit, it's going to drive up interest rates, meaning the price of loans becomes more expensive. Specifically, or to notice, the price of a loan is a real interest rate. The real interest rate is essentially just adjusted for inflation. Basically, better said, is an interest rate that's adjusted for inflation. Okay, and basically, we just subtract off the inflation rate from the nominal interest rate. This nominal interest rate is the rate when you take out a loan, like if you have student loans or you take out a mortgage, the nominal interest rate is the rate at which you have to return when you have to make interest payments on the principal. Okay? The real interest rate is that rate that's being paid. Subtract from that the inflation rate. That'll get you your real interest rate. So it's essentially the value of the repayment, the amount of goods that can be purchased with the repayment of the loan. Okay, so let's take a look at how that's conducted. So suppose that there's a $1,000 loan. You take out a $1,000 loan. Well, what's the real interest rate given the following scenarios? Let's assume that initially the nominal interest rate is 5%, meaning on a $10,000 loan, the nominal interest rate payment, or the nominal interest payment, is going to be the nominal interest rate of 5% times the principal of the loan. So the principal of the loan is called the principal. The principal amount of the loan times the nominal interest rate of 5%, so 0.05. So when we do that math, 0.05 times 10,000 is 500, which is exactly what we find for the nominal interest rate. If inflation is 2%, the real interest rate is going to equal the nominal minus inflation, where we use this symbol, the capital Pi, for inflation, as economists typically do. Well, your nominal interest rate, given the nominal interest rate is 5%, your real interest rate is 3%, meaning your real interest payment is only $300. Okay? So essentially what's happening is $200 of the interest payment is going towards to pay towards the increase in prices over the longevity or the maturity of the loan. Okay. Well, if inflation, let's say inflation increased, it's not 2%, now let's say it's 5%, and the nominal interest rate is still 5%. Well, the bank or the lender of the loan is essentially not making any money on it. There's no real interest payment. Why? Because the nominal interest payment is going exclusively to pay for inflation. Essentially, There's no increase in the number of goods that can be purchased with the repayment of the loan. The repayment of the loan is going to be the principal being repaid. So in this case, the $10,000 and the interest payment. So in total, the repayment, when the nominal interest rate is 5%, the total repayment is $10,000, $10,500. Well, if the if the inflation rate is 5%, then this total repayment buys the same number of goods as the original $10,000 loan. Okay? So again, in this case, the lender isn't going to profit from offering that loan. Okay? So essentially, the borrower doesn't pay anything to take out that loan because the inflation rate is exactly equal to the nominal interest rate. Okay? And so if you look through the rest of the scenarios here, nominal interest rate, let's say it jumps up to 10%. If inflation is relatively low at 2%, real interest rate's only going to be 8%. And a similar trend continues for the rest of the examples. Okay. So, when banks set these loans, they, if it's a 30-year loan, think about a mortgage, a 30-year fixed mortgage or 30-year mortgage in general. A 30-year fixed mortgage, let's say, where fixed meaning the nominal interest rate is locked into a certain rate. Well, in writing those loans, banks have to forecast what they expect inflation to be over the maturity of the loan, over the life of the loan, over the 30-year period. Well, it's relatively hard to do over 30 years. So these inflation effects can be relatively big if the nominal interest rate doesn't account for the actual inflation rate that's realized over the maturity of the loan. So up until this point, we've talked about monetary policy and loans and money, but we haven't discussed the institution that connects it all together, and they're banks. That's banks, depository institutions, financial intermediaries. So in the next video, that's what we're going to discuss.